Wall Street is bowing to big tech, but is the throne secure? This is Sectors Up Close, and we're talking about big tech. A handful of giants now rule the market, leaving some investors uneasy. The worry that the rally is too top-heavy and that the AI gold rush could vanish as quickly as it began. But others are shrugging it off. Megacaps have always driven the biggest gains, and right now tech is simply back on top. The Magnificent Seven now make up over 30% of the S&P 500. That's triple their share a decade ago. So with earnings season heating up, can the surge last, or are we watching a bubble ready to burst? Let's ask Leah Bennett, Chief Investment Strategist at Concurrent Asset Management. So Leah, Microsoft, Alphabet, Amazon and Meta are set to spend a combined $360 billion this year, much of it on AI. Will that cash keep flowing, or are we nearing a tipping point?
I read a great interview with Jeff Bezos the other day, and he was asked the same question. And his comment was, anytime we have new technology that comes through, every project gets funded, and investors aren't able to tell the difference between a good investment and a bad investment for quite some period of time. And, that appears to be what we're in right now. I do think we're more in early stages. It seems like this has been going on for a while, and you really saw things take off a few years ago with OpenAI and Microsoft in 2023. But if you look at the United States, we've well spent the rest of the world, and the rest of the world is trying to catch up with us, especially China. So I think spending on AI is going to continue to go on for quite some time.
Well, a lot of big tech earnings coming up this week, and they do have a history of smashing Wall Street estimates. Can we expect to see them this quarter, or is the bar finally getting too high?
Yeah, I mean, I do think that we're going to start seeing a rotation. The Magnificent Seven has led the market since 2023. They've had incredible earnings and revenue growth over that period. But if you look at the differential between the Mag 7 and the rest of the market now, the revenue is projected to increase for the Magnificent Seven at 13%, and for the rest of the S&P 500 at just under 13%. So you've had a narrowing of revenue expectations, but you are seeing a lot of other companies starting to perform much better. So I do think you have this broadening of the rally.
Well, questions are mounting as well on when these investments on AI will pay off. When will investors start demanding results?
If you think about growth investors, they're more agnostic about valuations, and they're more sensitive to the growth rates. So I think, again, if you see companies continuing to deliver strong revenue growth, and I do think that will continue to happen, and it doesn't necessarily have to be the big leaders that we've talked about in AI. It could be the application of AI to other sources. I do think you'll continue to see revenue acceleration, and you'll continue to see money going into those areas. Now, I do think you could see emerging markets start performing much better than what they have. You've seen emerging markets kind of come back this year, which is encouraging, but the application of AI to emerging markets could be really significant.
Well, there has been a frenzy of AI on AI deal making as well, but the same big players keep dominating. Is this concentration risk dangerous, or are they simply too cash rich to fail?
I do think they become too cash rich to fail, but I do think it is a concentration risk that under the current administration, they don't seem to be necessarily sensitive to. I do think if we have a change in leadership and we have a Democratic administration down the line, I think they could be looking at breakups.
But does this dominance limit where investors can put their money, or are there rising stars in tech and AI worth watching?
Yes, I do think, and asset classes. I mentioned emerging markets, which I do think could perform extremely well. I do believe in this rotation, even in the U.S. So I do think companies that, and this is where it becomes difficult to try to figure out who is going to really benefit and then who is going to be displaced. There's going to be a lot of companies that are displaced from the adoption of AI, but there's also a lot of companies that are not necessarily technology companies that have the potential to apply this new technology to their operating models and really drive operating earnings moving forward. And I do think we're starting to see that next leg of growth. And I think that's something that we'll see play out for the next several years.
Let's talk about China. It's vowed to boost its tech self-reliance over the next 5 years. Could China become a hedge if Wall Street's AI hype cools?
Yeah, I mean, I think China is definitely an area to watch. China is expected to spend $1.3 trillion in AI over the next 3.5 years, which is a very short period of time. They definitely want to have more independence from the United States on their AI and their technology resources. I don't think it necessarily becomes a hedge because I do think there's so much, as we've seen in the market even today, there's so much interdependence between the United States and China. But I do think it's another leg of growth that people should pay attention to. But I do think we've got to think about hedging portfolios in different ways.
That was Leah Bennett from Concurrent Asset Management. Don't forget, you can watch more videos on Reuters.com.